Divorce represents the closing of a chapter, and now you have an opportunity to take back control and think about what does your financial future look like now? How do you handle things like saving and investing? Ideally, you want to be able to take control of your money and your future. And now you have that opportunity because now you don't really have to answer to anybody else. It's up to you. You can certainly get help, but you're the one that's driving the car now. You're the one that gets to take the lead. Now that the emotional and legal side of all this is over, let's move to the investing and the growth side. And when it comes to investing, it is really important because we have this thing called inflation. And inflation means that things that you used to buy at one price over time, they cost more. And inflation is what causes that same thing, that same cup of coffee or that same item in the grocery store or that same piece of clothing. The price can change over time and it changes due to inflation. And so if we don't invest, it's going to be really hard for us to not see the value of our money from a purchasing power perspective go down over time. Because if inflation is 3% and your money sits in a bank account that pays less than 1%, that means that money in the bank is losing value because inflation is depreciating the value of your money and you're not getting back enough on it for your money to grow. And investing means putting your money to work for you, right? You can have a job and you can earn money that way. But then if you invest, you can let your money work for you and you can get things like dividends from your money. You can get growth from your money, and that can allow you to do other things. And that's really what you want to be able to, when you retire, you want to have that money sitting there so that you can have a new way to pay yourself, because you're not going to have a regular job, but that money that you saved, you can use that to pay yourself because you can take distributions out of that money over time. And that's the way that you kind of pay yourself. So you're saving so that you can pay yourself back in the future. What are those things that we need to secure before we start investing? The first thing we want to do is build an emergency fund. So if something happens, we have money to pay for it. We don't have to go into debt. If you have debt, you want to make sure that you put a plan in to pay it off, especially debt like credit card debt that can have higher interest rates. And you want to understand your cash flow. And the easiest way to do things like build that emergency fund when you're just starting is create a separate account and take some amount from your pay every week and put it in that account. Pay yourself first. Don't let that money go into your checking account or any spending account that you have. Put it in a separate account. Have that happen automatically. And if you do it that way, you don't see the money and it's harder to spend it because it's sitting over in there in a separate account. That's not money to invest either, because we try not to invest money that we're going to need within the next 1 to 3 or 3 to 5 years, somewhere in that time frame. You don't really want to invest that money because same thing happens if you were saving for a big purchase. You don't want to invest money that you're saving for a big purchase. You don't want to invest money for your emergency fund, because if you need that money and markets don't always go up, your investments don't always appreciate in value, and you don't want to make that thing that you were saving for less attainable because you had a loss of value during that short period that you were trying to save for it. So again, we want to start by building a secure foundation before we even invest. And that is to make sure we have an emergency fund. We want to address debt. Now, I'll tell you that I said that we want to pay off that high interest credit card debt, but there is one exception to that when we're going through this process. If you're working someplace and you have a match for the 401k, and the most common match is you save 6%, they give you a 3% match. That's a 50% return on your money. Regardless of how it does from a performance perspective, you just got back half as much. Because if 6% of my salary was $500, they're going to give me $250 in a match. You can't get that any other way. So that's a better return than the cost of even high interest debt. So in that case, it's okay to take some money and save and potentially invest. But other than that, you should be paying off that high interest rate debt. That should be your top priority. If your debt's too high, I mean, you might even think about whether or not you want to do that before you put too much into the emergency fund, because as you're paying off that high interest rate debt, you're lowering the amount of interest you're going to pay it on in the future, and you want to get it down to zero, because that's going to leave you with more money at the end of the day. So the sooner you can pay that off, the better off you are. And this is all part of understanding what your cash flow is, how much money is coming in and how much money is going out, which goes back to the idea of we want to have this budget to help us understand where everything's going. So once we've built that foundation, now we want to go to step 2, which is defining what type of investor you are. That's the who, and also the when, as in when do you need the money? I tend to think that if you're going to need the money in no more than 3 years, and for some people, if you're less risk tolerant, it can be 5. You don't want to invest that money. You want to be conservative. That's where it can go into a CD, it can go into a high interest bank account, something like that, that pays a decent rate of interest and is safe. But then beyond that, you have to determine what type of investor you are. Some people are risk averse, and so they want to have investments that are relatively safe, that are not volatile, which means the prices are not expected to move a lot. The risk of loss is lower. Then you have people that are moderate, that are willing to have some investments that are a little bit riskier, have a little bit higher chance of going down, but they also have a better chance of going up and having bigger gains. And then there's the aggressive investors that they're not that troubled by risk, and they're willing to take some shots at investments that can provide even higher returns. Just remember that in general, the more risk you take as you try to chase returns, that doesn't just work on the upside, it also can work on the downside. And that's why we want to find some balance. And when we think about investing, typically we think about, well, most of my clients, their investment allocation is somewhere between 50% stocks and 50% cash and bonds, and maybe 80% is at the high end, and then 80% would be stocks and 20% would be cash or bonds, because the cash or bonds are usually there to help minimize risk. But then even within that stock allocation, we can still be more aggressive or more conservative, because there's different types of investments. Some investments, you're only looking for the price of the stock that you buy to appreciate or grow in value. And other investments, they may pay dividends and give you some income. So you're going to get some type of return from that. And those are usually a little bit more conservative, because those companies are also a little bit later stage in their life cycle. So they are more mature companies that pay dividends. So that also usually means a little bit less risk. So again, in this second step, we want to define when do you need the money and what's your investor profile. And when I'm working with a client, there's some questions and some conversation that we can have to help determine that. And also this all fits into when we get to the financial planning stage, how you invest should fit your financial plan. And I'll tell you that be careful about chasing returns, because when you chase returns too much, sure, if the market does great, you're going to do really well. When the market does poorly, you're likely going to do even worse. And the last conversation I know I ever want to have with a client is to tell them that, that thing that we were saving for, that thing that we wanted to do when we retired, well, the market did really poorly and now we're not going to be able to do it. That's just a conversation I don't want to have. And I don't think it's a conversation or feeling you want to have either. The third step in taking control of your financial vehicle involves choosing your investment vehicles. So let's talk first about the different types of investment vehicles. There's cash. Everybody should know what cash is. There's bonds. And bonds are really, it's you lending money to a company or to the government if it's a treasury. That's really what a bond is. So you put money in, they pay you an interest rate, and then whenever that bond matures, you get your money back. Bonds and CDs are somewhat similar. The only difference is with a CD, you give your money to the bank and then they give you interest on it, and then you get your what you gave that money back plus the interest at the end. Those are more conservative investments, cash being the most conservative, and treasuries would be really close. Treasury or US government bonds are very close in terms of being in safety to cash. And then there's money market funds, and which are still conservative, not all that different than a bank account, a little bit riskier than a bank account just because of how government protection works, but generally safe investments. And then we get into mutual funds, which are collective investments. I'm not a big fan of mutual funds because their tax attributes are not as favorable as the next one I'm going to talk about. But in general, a mutual fund is a collection of assets. You can get a mutual fund that holds bonds. You can get a mutual fund that holds stocks. You can get a mutual fund that holds a combination of stocks and bonds. And there's lots of different kinds of stocks that can be in them. And then you have ETFs, which are like mutual funds. They're still collective investments. The big difference is the tax attributes of ETFs are generally a little bit more favorable. ETFs are more like stocks because you can buy and sell them during the hours that the market's open. With a mutual fund, you can only buy and sell after the market closes because they figure out what the price is based upon closing prices, and then that's what you get. So that's where they work a little bit differently. And then if a mutual fund makes a distribution to you, it can be taxable, and there's rules for ETFs that don't always make the gains or losses that are come from buying and selling securities within the ETF taxable, while they can be within a mutual fund. And then there's individual stocks. Individual stocks, if you pick really well, you can do great, but you can also do poorly because some stocks don't do well. And I don't remember the exact number, but a strong majority of stocks will hit some value and then they'll never get there again. Now, we're not making recommendations, but there's companies like Microsoft and Apple and ExxonMobil. Those are considered blue chips. They've been around for a long time. They've had a good history. They have their ups and downs along the way, but they've done really well. But there's also really risky investments in companies that go bankrupt. I remember one of the early investments I made was after my mother passed away, and it was a company that had a new cancer drug. And I was all excited about it because they were doing something that was going to try and cure a kind of cancer. And that's what made my mother died from cancer, and I was excited. And I bought this stock. It was terrible. The company eventually, I sold it before the company went out of existence, but there was really not a market for its product. And that's something I've learned when I look at individual stocks on those rare occasions that I do, is to understand what the market is. So there's a lot of things that you have to look at and understand if you want to venture into individual stocks. And then within these investments that I just talked about, within ETF and mutual fund world, there's passive investments and there's active investments. Passive investments are usually, and they can be ETFs or mutual funds, are usually meant to mimic an index, like the S&P 500. You can buy an S&P 500 mutual fund or ETF, and it's going to hold the stocks that are in the S&P 500, and it'll come pretty close to mimicking the performance of the S&P 500. You don't have to make any decisions. You have a broad diversification within that. You don't want to just do own the S&P 500 though. You can think about if you want to own small companies, medium-sized companies, because the S&P 500 is primarily large companies. You want to be careful about having a home country bias and only investing in the stocks of companies where you live. You should have some allocation to those outside the US if you're a US investor. So there's a lot of different things that you want to think about, but the main thing for most people should probably be passive investing and holding ETFs, where you get diversification through owning different ETFs and own a little bit different buckets of stock and give you exposure to different parts of the market. I mean, you can actually, there are some funds that are meant to represent the whole market. If you want to make it really simple, you can do something like that and have a bond fund that represents the bond market and the stock fund that represents the whole stock market. Make it very simple, and depends on what works best for you. Step 4, when it comes to investing one-on-one or taking control of your financial future, is updating your retirement vision. You might ask, why does it have to be updated? I think of it that things change. What might be meaningful to you today might not be meaningful to you a year from today or 2 years from today, or what used to be meaningful to you before your divorce might not be as meaningful now. So you want to make sure that you revisit and confirm that those things that are in your plan, you want to make sure that that plan reflects what's of value to you. I've written a blog in the past that was called, Are They Goals or Possibilities? And I really like calling them possibilities because we're not sure. We don't know. Think about it. You're investing for your future. And think about the person that you were 10 years ago and the person that you are now. You've changed. Most likely, we all change over time. So if we're a different person 10 years ago than we are today, we're probably going to be a little bit different person in 10 years than we are now. So that's another reason we're trying to save for a future self. And so the reason some people have trouble saving is they don't really know that person, so they're more hesitant to save for them. But the idea here is that your plan is a living, breathing document, for lack of a better word, but it changes over time. So you want to make sure that you don't say things or you don't cast things in stone. You want to be able to have the flexibility to change. And one of the questions I often ask when I'm working with somebody early on in their financial plan is I'll ask them, what is important about money to you? And what's really interesting to me about that is that the two most common answers I get are security and freedom. And if you think about it, it makes a lot of sense, because before we're comfortable with where we are financially and what our future might look like, money is there to provide security. But if we're fortunate enough to get to that point where we feel secure, that's where we get to money can now provide us freedom. And that's where I get into the idea that I think of it that we have a team of capital. We have our time, we have our energy, we have our attention and our money. Those are all sources of capital. And the interesting thing is, if you think about it, you can exchange your money for more time. You can exchange your money to save you energy. And you can use your money to free up your attention. And just to give you a quick example, I love to tell this story. When we moved into the house that we live in today, we first bought the house, and the woman who owned the house before us had a tractor. I'm like, I'm going to buy the tractor from her. I'm going to cut the grass. I'm going to save the money and cut the grass. And I found that it took me 3 hours, and I wasn't even finishing. The only part that I really enjoyed was when one of my kids would take turns sitting on my lap while I was driving the tractor and be with me. That was nice, but not that nice, right? Like, because I could have done better things. And my wife found that there was somebody in the neighborhood that was cutting lawns for a bunch of my neighbors, and it was $40. And I knew he wasn't going to take 3 hours. And it ends up he took about half an hour to do it. But when she told me it's $40, I said, okay, I can take $40 and I can save myself 3 hours of time. And now I can do something a lot better with my kids, with my wife, with my family, than cut the grass. So I was very happy to have somebody else do it. That's a great example of how we can use our money to buy back time. And so as you think about all this, nothing that you do when you're trying to create your retirement vision is set in stone. And as a life planner, I do a lot of work with clients to help them understand and realize what that vision is. But even when we do your life plan, it doesn't mean that it's one and done. It still can be an iterative process, something that we want to revisit and update over time. The fifth and final step in Investing 101 is, where do I go to start investing? Do I work with a financial planner, or do I do it alone? And there's lots of ways that you can think about this. One thing that I often say is that In some ways, anybody can do what I do, but in order to do it well, you have to have what I refer to as KIT. You have to have the knowledge, you have to have the interest, and you have to have the time. And if you don't have those three things, then it probably makes more sense to get somebody to help. And the other thing to think about is that if you have a medical issue, you go to a doctor. If you have something wrong with your car, you take it to a mechanic. Why do you take it to those people? Because they have training, education, knowledge, whatever you want to call it, that allows them to help you with those issues. Well, the same thing applies to working with a financial planner or any other professional. They have knowledge and experience that you don't, so that while you can do it with them, if you have them there to help guide you and advise you, it gives you a better chance of getting a better answer. One of the things that I do, I talked about the life planning before, but I also am a CPA and I help people with tax planning. And to me, taxes and investing are joined at the hip. And so if we can take taxes into consideration when we're investing, we can do what I strive to do, is to figure out how we can pay the least amount of taxes over our lifetime. Like if you have a year where you pay almost nothing in tax, you might think, oh, that's great, I didn't pay anything. But if it means that in the future you pay a lot more because you were in a higher tax bracket and you could have pushed some of the income into that earlier year, that was really not a good result to pay almost nothing that 1 year because you passed up. The tax bracket start at 10 and 12%, then they go to 22 and 24 and then 32. You almost never want to pass up the 10 and 12% bracket. So if you didn't at least fill those up, then you probably made a mistake. So these are the type of things that you can find out when you work with a financial planner. That some people are do-it-yourself and they're content to do it on their own, but it can also help to have somebody there that's kind of looking over your shoulder, that's checking in on you and making sure that you're doing the things that you said you're going to do and following through on them as well. You've taken control of your life, and now you're taking control of your financial future too. If you need personalized help navigating how to get started in investing, schedule a free 15-minute call with me. You can find the link below.